Okay, let's review this class. As I said, for the final exam, it will only cover classes not included in the middle term. So it's a non-cumulative exam. So we basically have three components after the middle term. The first one is the long-term financing, and the second one is the short-term financing, and the third one is some special topics. So first, let's talk about long-term financing. And the central topic here is, as a firm, how can a firm get money for its long-term investment? And we have actually three chapters talking about this. Chapter 3 is about issuing equity to finance investment. And chapter 24 is about issuing debt to finance investment. And then chapter 25 is about leasing. Chapter 24 is pretty simple. So if you're interested, you can read chapter 24 yourself. And for this class, chapter 24 is not required. So I would only review chapter 23 and chapter 25 here. So first, for chapter 23, we talked about issuing equity. In terms of thinking about this chapter, right, you could think about the life cycle of a firm. So if you're a young firm, you're pre-IPO, then you're just a private firm. Then we could talk about equity financing for a private firm. And then as the firm matures, it will file for IPO. So we would talk about this initial public offering. And then after IPO, the firm could do some other rounds of equity issuance. And in this time, we will have seasoned equity offering. So we basically have three sections: private firm equity financing, IPO, and SEO. And then, so basically equity financing for private firms, this section is pretty simple. There are two major focuses here. The first is we discussed different sources of funding, right? We talk about angel investors, VC firms, PE firms, institutional investors, and corporate investors. I would say this piece of knowledge is useful for the purpose of understanding the basics. And then we discussed the pre-money valuation, post-money valuation, amount invested, and percentage ownership. So this part requires some calculation. And you can expect, or you could guess, the final exam will focus a lot on calculation. So whenever a particular section is about calculating something, you got to be careful, right? You should make sure you understand how to do the calculation. So in this case, the formula is quite simple. It's basically post-money valuation. That is, the firm's valuation after receiving money equals its pre-money valuation plus amount invested. And then it's also pretty important for you to understand how to calculate percentage ownership. And your homework has one problem on this. So it's good if you could practice that problem and make sure you understand it. Okay, percentage ownership is pretty easy. So let's say you invest, right? Let's say you invest $100. And then the post-money valuation is 1,000. Then your ownership would be 100 divided by this post-money valuation, which is just 10%. Of course, this is basically the simplest case. And for the homework, you get a more complicated case with multiple rounds. So it's good practice. And then after the firm matures, it will file for IPO. We talk about several topics in IPO. First, we talk about the benefits versus costs. Then we talk about different types of offerings, best effort basis, firm commitment, and auction. And then we discussed empirical results from research on IPOs. So there are basically 4 interesting results. First, we could see underpricing. That is, generally, the first day return for this IPO the first day return for IPOs is generally significantly positive. And then the second result is cyclicality, which means if the economy is good, you will see a lot of IPOs. And if the economy is bad, you will see very few IPOs. And then the third one is about the high cost. That is, IPOs are very expensive in terms of percentage terms. I can't remember the exact number, but I think the average is about 7% of the offer size. That is, if you issue $1,000 million, then you have to pay $17 million as your cost for filing for IPO. And then there is the fourth result, that is poor long-term performance. That is, if you buy this IPO and if you hold it for a long term, let's say 3 or 5 years, then in the long run, you will see this IPO stock actually underperforms the market. These results are quite famous and interesting results in IPO literature. And the reasons for these results are actually also very interesting. So for example, if there's for underpricing, right? We learned the reason is because winner's curse. It basically means if it's a good IPO, you cannot win. That is, you cannot get into this IPO. If it's a bad IPO, then you will easily buy the IPO shares. So it basically means if you get to buy the IPO, it's possibly because the IPO itself is bad. And there is a lectional problem on this underpricing winner's curse problem. So make sure you understand it. And I personally like that problem. It's quite interesting. And then why there are high costs? Well, because at least from the textbook, it's a signaling theory. It basically says investment banks, they want to charge high fees to justify that they're high quality investment banks. And then why there are long run performances in the IPOs. The explanations are first, market timing. That is, firm will only file for IPO when it is overvalued. So investors will buy overvalued shares at IPO. And in the long run, overvalued shares will go back to their fundamental value. So the price will decrease, the return will be abysmal. And then the second explanation is about exercising growth option. It basically means as the firm files for IPO, it becomes less risky. And we learned that if a investment has smaller systematic risk, then its returns should be smaller. Okay, then we discussed SEO. So basically, SEO means seasoned equity offering. That is, after the firm files for IPO, it can do some other rounds of equity issuance. So in this case, we will have SEOs. And then I would say this section is pretty simple. So basically, first, we have two types of SEOs. Cash offer, rights offer. Cash offer basically means if you have cash, then you can buy shares. Right offer means only the existing shareholders have the right to buy shares. And then we also can see this performance of SEOs. We generally see that share price decreases if there is a seasoned equity offering. And then the explanation is pretty much similar to the explanation of the long run poor performance of IPO. In the case of SEO, you could argue that, well, firm will only do SEO when the share is overvalued. And then you could also say that if a firm does a SEO, then it exercises its growth option, so it becomes less risky, then the return should be naturally smaller. Okay, so that's for chapter 23. And then chapter 25 is leasing. And this chapter is, I would say it is heavy on all kinds of calculations, right? So first we start with this benchmark case. So we are basically looking at a perfect capital market. Specifically here, we don't consider tax. And in this case, leasing and buying with debt, they're essentially the same. And in this section, you need to understand how to calculate lease payments. And you also need to understand how to calculate loan payments, right? So basically, this is a perfect capital market. Then the present value of lease payment equals the purchase price minus the present value of residual value, or end of period value when your lease ends. And then there are also some concepts here. That is, the residual value could have different values depending on your contract, right? It could be fair market value. That is, the market value of the asset after your lease ends. Or it could be worth just $1. So this is a $1 out lease. That is, if you exit your lease, the residual value of the asset will be just $1. And then there is this fixed price, which means no matter what is the market value, as the lease ends, if you want to purchase the asset, you will just pay a fixed price. And then because in this perfect capital market, lease and buying with a loan are essentially the same. So we will have this equivalence result. That is, you first pay the lease payment, and after lease ends, you will purchase the asset at its residual value. Then the sum of these two terms should be the same as the present value of your loan payments. That is, should be the same as the purchase price. And then we discuss lease accounting and lease tax. So in terms of lease accounting, we have two kinds of accounting rules. We could have operating lease, or we could have capital lease. Because this is open book, right? So it's easy for you to check what is the definition of operating lease and what is the definition of capital lease. Basically, if it's operating lease, then it means that the lease payment should be recorded as operating expense on your income statement. If it's capital lease, then it's more complicated. You will basically record this leased asset as acquisition, and because it's acquisition, then this will have some changes on your balance sheet. So you will record this as your asset, and then you will record the present value of future lease payments as your liability. And then what else? Oh, your income statement, right? So you will have depreciation from this leased asset, and then the interest rate portion of the lease payments will serve as your interest expense, right? So this will change your earnings. And then in terms of the tax rule on lease, we have true tax and non-tax. Roughly speaking, true tax lease matches with operating lease. Okay? So the lease payment will be treated as operating expense, and then the non-tax lease matches with capital lease. Right? So you will have to consider depreciation, and you will have to consider the lease the interest portion of the lease payments as interest expense. And then the main or the more difficult part of this chapter is about how do we think about leasing versus buying in the imperfect capital market. So here specifically, the imperfection we consider here is the existence of corporate tax. Right? So in this case, the rationale is you can consider this as a two-step process. First, you will calculate the lease versus buy incremental cash flow. Obviously, this one is actually quite, it's a little time consuming because you basically have to first calculate your free cash flow from leasing, and then you will calculate your free cash flow from buying. And then you will calculate the incremental cash flow by calculating the difference between leasing cash flows and buying cash flows, right? Obviously, I cannot get into much details, but just look at the lecture notes. You can see the detailed steps. And then this is basically the first step, right? Getting incremental cash flows. Now, the second steps, well, you can have three methods. First, you could look at this lease equivalent loan. Second, you can calculate the NPV of the incremental cash flows. Third, you can calculate the internal rate of return of the incremental cash flows. And then I also have summarized these rules for you to judge whether you should buy or whether you should lease. Say in the first case, if you want to use this lease equivalent loan, then you will compare the year zero cash flow versus the loan balance. And if the year zero cash flow is smaller compared with the loan balance, then buying is preferred. Roughly speaking, let's say if you have incremental cash flow looking like this, right? So if you discount your liability, and let's say the present value of this is 11, then this is year 0, year 1, year 2, year 3, year 4. And then you would compare this number versus this number. And you find out 10 is more than 11, so buy is preferred. So this one is easy to understand, right? Sorry. So this 11 is your liability, and this 10 is your benefit, right? So it's like you have to bear $11 of liability, but you can only get $10. So obviously, lease is not preferred. And then you could also calculate the increment. Sorry, you could also calculate the net present value of this incremental cash flow, and in this case, you will calculate, or you will discount all these cash flows, And let's say in the end you find out NPV is -1. Then in this case, it means buying is preferred. Oh, by the way, when you calculate the present value or the loan balance, you have to discount these future cash flows with after-tax debt cost of capital. And then you could also calculate IRR, that is the discount rate, which makes the present value of these cash flows 0. And in this case, if IRR is larger than your after-tax debt cost of capital, then buying is preferred. Okay, second component is about short-term financing. And we have two major chapters. The first one is managing your working capital, and the second one is short-term financial planning. So the starting point of understanding working capital management is you have to understand how to calculate the different days, right? Accounts receivable days, inventory days, accounts payable days, and then 2 cycles, operating cycle and cash cycle. So accounts receivable days basically means how many days, right? You have to wait before receiving payments from your customer. The inventory days basically means how many days you can convert your inventory into products. And accounts receivable days means how many days you can delay your payment to your supplier. And then operating cycle means how many days you can buy raw materials and get money from your customer, right? And this cash conversion cycle, it measures or it tells you the days between when you pay your supplier and the day when you receive payments from your customer. So basically you can see that these days and cycles, their efficiency measures. And for accounts receivable days and inventory days, generally you want these days to be small, right? Because that means you're operating your working capital more efficiently. And then for accounts receivable days, generally you want to be large, but you don't want it to be too large. This one is more nuanced because you have to think about credit terms and you have to think about whether you want to pay early or late. So this one is really a more nuanced, detailed case-by-case case. And then for operating cycle and cash conversion cycle, your measure is you would want to compare your firm with your industry peers, and you would want to see that whether your cycles are longer than your industry peers or not. Okay, so in terms of thinking about working capital management, it's useful to think what is net working capital, right? So net working capital is current asset minus current liability. And then current asset has 3 important components: accounts receivable, inventory, cash. So obviously, if you want to consider how to efficiently manage working capital, then you have to think about accounts receivable management, inventory management, and cash management. So this section is basically about all kinds of basic concepts. So it's not a hard chapter. So in the case of accounts receivable management, the important topic here is you have to understand trade credit terms, right? For example, if I give you 210 net 30, it means that you can pay as late as, It means that your customer can pay as late as 30 days. But then, if the customer decides to pay at 10th day, there would be a 2% discount. So this basically means you can calculate the implied interest rate, right? Because it means that if you pay at the end of the 30th day, you pay 100. And if you pay at the end of the 10th day, there's 2% discount. So you would only pay, $98, which means the 20-day interest rate would be 100 divided by 98 minus 1, right? So it's about 2%. Yeah, I guess it's about 2%. Obviously, in the exam, I could ask you the annualized rate, so you'll need to understand how to convert 20-day interest rate into annual rate. Okay, of course, we have some other basic so we have some other basic concepts as well. So we have the inventory management, and you need to understand what are the benefits and what are the costs, and cash management, what are the benefits and what are the costs. And then on the current liability side, our major focus is the accounts payable management. And again, you have to think about the trade credit, right? So basically, let's say you have accounts payable on your balance sheet, and you have this 210 net 30. Then you have to think whether you want to pay your supplier at the end of the 30th day, or you want to pay your supplier at the end of 10th day. Again, you have to think about the implied interest rate, right? Okay. So chapter 27 is about short-term financing. It basically asks 3 questions. First, do you have a need for short-term financing? Second, how do we implement short-term financing if we do have a need for short-term financing? And third, how to obtain short-term financing. So to answer whether we need for short-term financing, the basic step is you will want to forecast your short-term cash flows. And if you expect you will have some negative cash flow shocks in the near future, then you could consider to obtain some short-term financing. And the textbook discussed 3 scenarios under which you could have negative cash flow shocks, such as seasonality, negative cash flow shock, and positive cash flow shocks. Okay. Next, we talk about how to implement short-term financing. The simple answer here is we would use matching principle. So it means if you have short-term needs, then you should finance your short-term needs with short-term debt. And you should finance long-term needs using long-term debt. And this basically implies permanent working capital should be financed with long-term debt, and temporary working capital should be financed with short-term debt. Here, permanent working capital is also considered as fixed working capital, which means the minimum level of working capital you have to maintain if you want to operate your business. And then temporary working capital is also called variable working capital, which means this piece of working capital can change depending on your business operations. Mathematically, it's essentially the difference between working capital and permanent working capital. And then a related topic is we discussed aggressive financing policy versus conservative financing policy. Aggressive financing basically means you will finance everything with short-term debt. Conservative financing means you will finance everything with long-term debt. And then there are pros and cons between these two approaches. So if you're aggressive, if you're using short-term debt to finance everything, it means you will have cheaper debt cost of capital because short-term debt is cheaper compared with long-term debt. But then you will have other problems. You have to refinance, like say, every 6 months. So this will incur more transaction cost, and potentially you could run into problems if you cannot refinance. And then long-term debt is more, it's safer, right? You will always have your financing in your pocket. But the cost is it's more expensive because long-term debt has higher interest rate compared with short-term debt. And also there are some implications on managerial incentives. So if you have long-term debt, you will have some additional free cash flows. This means this could generate some incentive problems. For example, if the manager has a lot of cash flows, then potentially they could engage in wasteful investment and empire building, right? Okay, the third topic is about how do we obtain short-term financing. So there are three forms: bank loan, commercial paper, and secured financing with account receivable and inventory. And the main focus here is bank loan, because you can see that we have both homework and lecture notes about calculating your annual rate, your effective annual rate. The thing here is bank loan is a little complicated because there are some additional transaction costs, right? And we learned three forms of additional transaction costs. That is loan commitment fees, loan origination fees, and compensating balances. And all these transaction costs will push up the firm's borrowing cost. And you need to be able to calculate, right? You need to be able to calculate the effective or the actual interest rate after considering these three different kinds of transaction costs. Okay, then we talk about three topics. And to make your life easier, I decided to remove chapter 29. So corporate governance, this chapter is not required. Again, it's a pretty simple chapter. So I believe if you are interested in this topic, you can read the textbook yourself. So we now have three chapters: merger and acquisition, risk management, and international corporate finance. Okay, our first topic, merger and acquisition. So the first section on this chapter is about some empirical results on the on merger and acquisition. First, we observe that there is a high acquisition premium. So acquisition premium is pretty much the price paid by the acquirer minus the pre-merger market value of the target. For example, if the pre-merger target market value is $100 and the acquirer paid $150, then in this case you can see that there is 50% acquisition premium. And we also discussed the market reaction to merger and acquisition. And we find out the target firm will enjoy large gains. So on average, 15% if there is an announcement of M&A. And then the acquirer, its stock price is generally flat. It's about 1%. And then we also discussed motivations for M&A. Again, we talk about a lot of reasons, I guess more than 10 different reasons. You can read these reasons yourself. And then we talk about the merger and acquisition process. So basically, three main processes. Um, First, valuation. I mean, this is very basic, right? If you want to acquire a firm, you definitely want to do the homework yourself, and you want to value what is the market value of the target, and what is the potential synergies you can get from merging with the target firm. And then there is offer process. Depending on what kind of form of payment, we can have cash offer, or we could have stock offer. We could have a combination of these two different offer types. So cash offer basically means the acquirer will pay cash to acquire the target firm. Stock offer means the acquirer will use its own stock to buy the target firm's shares. And if it's a stock offer, then we need to know how to calculate exchange ratio, right? So exchange ratio is basically defined as the division of X and NT, right? So what is X here? So here this X means the number of shares the acquirer has to issue to pay for the target firm's shares. And then this NT is the number of shares of the target firm. And this T is the pre-merger value of the target firm. S is the potential synergies from the merger. And A is the pre-merger market value of the acquirer firm. And this NA is number of pre-merger shares for the acquirer firm. And then NT is the number of shares for the pre-merger target firm. Alternatively, we could use this formula. So here, PT is the pre-merger share price of the target firm, and the PA is the pre-merger share price of the acquiring firm. And then after making offers, we will have this approval process. So if the acquiring firm wants to acquire the target firm, then it needs to be both approved by the board and the shareholders. And depending on what the board and management of the target firm wants this acquisition, we could have friendly takeover or hostile takeover. So if the board and the management they're happy with this acquisition, then this is a friendly takeover. If they're unhappy, if they resist the acquisition, then this is a hostile takeover. And then we discussed takeover defense. So we discussed several different forms. Poison pills, staggered board, white knight, golden parachute, recapitalization. I won't get into details on these different forms of takeover defenses, but it's useful if you have a basic understanding what these things are. Okay, and then we want to understand why there is a high acquisition premium, right? Because we learned the acquisition premium is about 43%. It's very high. And we find out because of this acquisition premium, target shareholders capture the value added from merger and acquisition. So this basically means that if the acquirer acquires the target firm, and this target firm has a, let's say, $100 of market value, and let's say the value added from this merger and acquisition is $43, then the target shareholders, they will capture all this $43. Now, why do we get this result? Well, the explanation is, first, we have this free rider problem. And then second, we have the competition between acquirers. Free rider problem basically means these target shareholders, they understand once the acquiring firm acquires the target, they will make improvements to the target firm. So they understand that in the future, the target firm will have a higher value. Thus, they will demand higher value from the acquiring firms to sell target firm shares. So in the end, the acquiring firms is forced to pay a high premium for target firms shares. So it's called free rider problem because target firm shareholders, the free ride on the acquiring firm's efforts to improve the target firm. And competition is easy to understand. It basically means that if this is a good firm, if it becomes a target, then a lot of other firms will compete for acquiring this target firm. And the competition between acquirers will increase the bidding price. And in the end, it will become expensive for acquirers to acquire the target firm. So target firm shareholders will capture the most value added from merger and acquisition. And then we also discussed the solution to free rider problem. First, the acquiring firm can build up stakes in the target firm secretly. But we also know that according to law, the maximum percentage you can buy is 10%. After 10%, you have to disclose to the public you have accumulated 10% shares. So if you can secretly build up stakes in the target firm, this can mitigate partially free rider problem, but you cannot completely remove free rider problem because this 10% restriction. And then we also talk about LBO, that is leverage the buyout and freeze out merger. And these two kinds of financial maneuvers will be able to mitigate free rider problem. Okay, chapter 30. So this is about risk management. And this is a very long chapter and we have a lot of calculations. And potentially you will feel it's difficult. The reason is because we discussed the futures, right? So this is a completely new kind of derivatives, and so that's why it could be difficult. But I have to say, futures are very important for risk management, so we cannot avoid discussing futures, unfortunately, for this chapter. Okay, so first, what are the tools we can use for managing risk? So the first one is very conventionally useful, right? Buying some insurance. And in this chapter, you need to understand how to calculate fair premium. So essentially, the fair premium of the insurance is the discounted value of the expected insurance payout. And then we discussed the value of insurance and the cost of insurance. And the second set of tools we can use, which is also more advanced, are options and futures. And you guys have learned options in corporate finance too, but it's possible this is the first time you learn about futures, right? So it's important for you to understand the basics of options and futures. That is, what is a call, what is a put, what is a strike price, what is the expiration date, and what are long and short positions in the futures contract, and what is the delivery date for a futures contract. More importantly, and you have to make sure you know this because this is very, very important to understand risk management in chapter 30. Make sure you understand how to calculate your payoffs from call and put options and your payoffs from long and short position in futures, right? I can't stress enough how important this is. if you look at the election of the problems, I would say for chapter 30, about, I don't know, maybe 80% of problems require you to calculate some forms of payoffs, right? So please make sure you know how to calculate payoffs. And then you also need to understand how marking to market works. Right? So it basically means that if you have a futures position, your daily loss and your daily gains will be calculated like every day, right? And this daily loss and daily gains will also be realized every day, which means if you have a daily gain, then you will get money. If you have daily loss, you will have to pay out money. And then we have three topics about hedging. The first is about hedging commodity price risk. We have these different methods for hedging commodity price risk. Vertical integration, which means if you integrate with your supplier, you can at least partially mitigate the price risk from your supplier, right? Then you could also do storage, which means you can buy 1 year of wheat, then you can guarantee that for the next year, you don't need to suffer from changing wheat price because you have wheat in your storage unit. And then we have long-term contract. That is, you could sign a contract with your supplier and fixing your price at a certain level. And then we discussed futures contract and options contract. So the idea here is if you have to buy something in the future, then you should take a long position in the future, because a long position commits you to buy something in the future at a fixed price, right? For example, if you want to buy wheat in 1 year, then you could enter the long position in the wheat futures contract, and then you commit yourself to buy wheat in 1 year at a fixed future price. And you can see that why this can hedge your price risk, because once you enter into this contract, you know that in the future you will pay a fixed price for wheat, right? And if you need to sell something, you should enter into the short position of the future, because just like, this is essentially the opposite position of the long position, right? So if you're in the short position, you commit yourself to sell something in the future at a fixed price. So you know that you're guaranteed to sell at a certain price in the future. And then options contract can also be used to hedge commodity price risk. If you want to buy something, then you should buy call option, because call option gives you the right to buy something at the fixed strike price, right? And if you want to sell something, you should buy a put option, because put option gives you the option to sell something at the strike price. Again, you need to understand how to calculate the payoffs if you're using futures contract and options contract to hedge against commodity price risk. Obviously, I cannot go into details, solve a whole problem for you, but the lecture notes have a lot of problems. Okay. Now, hedge exchange rate risk. We have three methods. First, we could use currency forward contracts. As I said, for simplicity, you can consider forward contracts as futures contract. Of course, they're different because forward contracts are generally traded OTC, and it's not market to market. But for this class, it suffices if you consider forward contracts as futures contract. So you need to understand how do you use currency forward contract to hedge. And again, what kind of payoffs you can get from forward contract. And then, importantly, we discussed this covered interest rate parity. Right? So we learned about this. This one is important because in future, in the chapter 31, you will see this again. Right? So first, this formula can be used to tell you what is the fair price for the forward contract. That is, you can use the formula to find out F. And also this is called covered interest rate parity because it is related to the interest rate of these two different currencies. And then you could also use this cash and carry strategy. Essentially, cash and carry strategy is used to replicate the currency forward contract. In the lecture note, you can see a specific problem. In that case, you can see that a bank does not have access to the currency forward contract. So it replicates this currency forward contract using a cash and carry strategy. So make sure you understand that problem. And another way is currency options. Again, you need to understand which option to use and what kind of payoffs you can have if you purchase options. Okay, the last one is about hedge against interest rate risk. So in this chapter, in this section, it's very important for you to understand the duration, right? First, how do you calculate duration, which is given by this formula? And then you need to understand that duration is important because it helps us to understand interest rate risk. The reason is because the percentage change in portfolio value is equal to minus the duration of the portfolio times this thing. Remember that this epsilon is just the change in the interest rate, and R is interest rate, K is compounding period. Okay. And then after introducing duration, we discussed immunization. That is, we could hedge against interest risk by modifying duration. So remember the case, the example we discussed in the lecture note. We had a bank which wanted to hedge against interest rate risk. And our goal is to make sure the bank's equity is zero. And you can see that the rationale here is pretty simple because if the duration of the bank's equity is zero, then it means even if interest rate changes, then the equity value will stay the same. And how do you achieve this, right? How do you make sure the bank's equity will be zero? Well, you can buy and sell the bank's asset to make the duration of equity equal to zero. The idea here is equity can be considered as a portfolio of asset and liability. So if asset has a very long duration, then you should sell asset to reduce its duration. In this case, you will reduce the equity's duration to zero. And we also have a formula which tells you what is the amount of asset you want to sell or you want to purchase in order to immunize the equity against interest rate risk. So as I said, this is a confusing formula because the notation here is not exactly right. In our case, this portfolio refers to equity. Again, I'm skipping a lot of details here. Just make sure you read through the lecture note. It's a very detailed example, right? And it will teach you how to calculate duration, how to calculate the equities duration, and how do you exactly modify the firm's balance sheet to achieve that the firm's equity has a duration of 0. Okay, then we talk about swap-based hedging. The definition of the definition of interest rate swap is pretty easy. It basically means that you're swapping two different kinds of interest rates. For example, you could pay fixed rate and receive market floating rate, or you could pay floating rate and receive fixed rate. And the simple rule for using interest rate swap here is, if you believe the market rate will increase, then you should swap fixed for the market rate. That is, you will want to pay fixed rate and receive the market rate. This is quite intuitive, right? Because it's like you're paying a low interest rate to get a high interest rate. And on the other hand, if you believe the market rate will decrease, then you should swap the market rate for the fixed rate. So you should pay the market rate and get the fixed rate. And we have also discussed a specific example how to use interest rate swap to hedge against interest rate risk. So again, make sure you understand that lecture note problem. And then we have another example which talks about how to use interest rate swap for immunization. So the intuition here is interest rates, if you enter into this interest rate swap, then let's say if you're receiving the fixed rate, then this swap is equivalent to buying a long-term bond and selling a short-term bond. The reason is, if you're receiving fixed rate, then it's like you're buying a long-term bond, right? Because if you buy a long-term bond, you will get or you will receive a fixed rate in the long term. And because you're in the swap, if you receive the fixed rate, you will have to pay the variable rate. And paying the variable rate is equivalent to the fact that you're selling a short-term bond. Because if you sell a short-term bond, then you will have to pay the variable rate. And because swap can be considered as buying long-term bond and selling a short-term bond, this implies that you can use swap to modify your portfolio's duration. Again, look at the lecture note problem. It exactly tells you how this is done. Okay, so the last chapter, chapter 31, is about international corporate finance. Essentially, it's corporate finance by considering exchange rate. We basically discussed the two cases. The first is the benchmark case. It's the internationally integrated capital markets. And in internationally integrated capital markets, we have an equivalence result. That is, if you value a foreign project, you have two methods. And these two methods should give you the same result. So essentially, you can first compute foreign present value using the foreign cost of capital. And then you will convert at the spot rate. This will give you the domestic present value. So this is the first method. In the second method, you can convert the foreign cash flow. You can convert the foreign cash flow using the forward exchange rate. And after that, you will discount this converted cash flow with domestic cost of capital. And because capital markets are international integrated, and these two methods should give you the same result. And then because of this equivalence result, we will get this formula. So this formula is somewhat similar to the covered interest rate parity, except here we are using cost of capital, right? Because for covered interest rate parity, we use risk-free rate. And then there are two tricks about doing valuation in the internationally integrated capital markets. The first one is finding out forward exchange rate. Because what you can see here is when you're doing valuation, you will need this forward exchange rate. Right? And if the problem gets tricky, if the problem does not tell you what kind of forward exchange rate you're getting, then you should use the covered interest rate parity to calculate the forward exchange rate by yourself, right? And the second trick is this foreign cost of capital. Again, if the problem gets tricky, it does not tell you what is this foreign cost of capital. And then what you can do is you can back out this foreign cost of capital by using risk-free rates and the domestic cost of capital. Again, check the lecture notes and see how this is done. And finally, we discussed internationally segmented capital markets. And the segmented capital market can be considered by comparing these markets with our benchmark case, right? In the benchmark case, capital markets are internationally integrated, which means we have this equivalence result. So if capital markets are not internationally integrated, that is, if capital markets are segmented, then this equivalence result can fail, which means these two methods could give you two different answers. And we have a lecture note problem on this. And also that these two tricks might fail. That is, the covered interest parity could stop working. And this second formula could also stop working.